I'm Rachel.
I'm Brandon.
I'm Callie.
And we will be presenting RIO Tinto.
Thank you. So for what we're going to be presenting to you today, we're going to start with the business overview, tell you a little bit about what RIO Tinto is. Then we'll cover their financials, some key growth drivers of theirs, their evaluation, risks, and then we will end with their portfolio fit and some recommendations, and then summarize our ideas. So for starters, RIO Tinto is the second largest metals and mining corporation in the world. They are a cyclical stock that is currently recovering from the pandemic. They are leading in both iron and aluminum in the world production. They are also a basic materials stock, which we currently do not have in the fund. They're also global, which would also add to the fund. We are currently recommending a strong buy of RIO due to their ample growth opportunities, consistent dividends, which other stocks in our fund do not offer, and their diversification options. So as I said, we are recommending a strong buy, thanks to its growth opportunities, strong balance sheet with low debt, and their dividend options. We are recommending a strong buy of 270 shares, and also a sell of 30 shares of EMR, as well as 80 shares of Apple, which would cover the cost, roughly, of the 270 shares of RIO. Current price for RIO was $64 as of close on Thursday, and our target price of $87 brings us to a target return of 44%. Thus why we are recommending such a strong buy. This business is made up of mines, smelters, refineries, and research and development, which brings about opportunities with decarbonization and in the infrastructure bill, which we will talk more about. There's also some challenges, however, with ESG development and fluctuation in commodity prices. We will also be telling you a little bit more about our key growth drivers with China and the rest of the world reopening from the pandemic, as well as supporting that with some mine expansion projects. And then we will cover some risks with China and commodity price fluctuations.
Okay, so in this chart right here in figure 2, we created a chart based on the stock price of RIO compared to iron ore. Iron ore is the main commodity that drives revenues for our company. So we can see that iron ore was way up to $220 at the half year, but now it's starting to come down a little bit for the years coming after 2021. And then in this table here, we can see that PE and EPS have been bouncing around a little bit, mainly due to our stock being cyclical. Earnings are kind of up and down. And then we can also see that ROE for the company is really strong. It has been increasing since 2019, which is very good for the company.
So over the past 5 years, you can see our yearly revenues increasing just about every year, and that's giving us 20% growth from those 5 years. And as we said, iron ore makes up a very large percent of RIO's total revenue, giving us about 65% in 2020, and the second largest being aluminum, which we'll talk about more. From the past 3 years, iron ore has continued to make up more and more of total revenue, as well as aluminum decreasing. It is still one of their main drivers, with the other commodities being gold, diamonds, copper, and industrial materials. So some of the opportunities with their ESG. Their main points are decarbonization, which they are doing through renewable energy, which is coming from their byproducts from their mines. And then this is all part of their 50% carbon reduction plan, which they are partnered with ELSIS, which is working to produce aluminum at a zero carbon footprint. And this is all part of their $7.5 billion decarbonization plan. And they're currently in the process of scope 1 and 2, and they are planning to put in scope 3 to reach 100%.
And with RIO being a mining company, there are obviously some risks involved with ESG, especially with the environmental safety risks with destruction of habitats and indigenous like sacred sites. For example, they did destroy a sacred site in Australia. However, they are working to counteract these issues, and the chairman that was the lead on that project has actually taken full accountability and will not be running for re-election for chair. And they're trying to work to be more cautious with this through research and development. And we are overall rating this a neutral stock for ESG, seeing as they are a mining company. There are a lot of risks involved with the environment. However, for being a mining company and taking into consideration that that is common, they are relatively favorable for ESG, considering they do have a lot in plan and in action to reduce the carbon footprint and other ESG problems.
So in this slide, it summarizes the firm's past performance based on financial ratios that we calculated. Few ratios of interest is the debt to equity ratio. It has been coming down since 2018. This is exceptionally good for the firm because they are paying off debt very easily. And if there are future economic disruptions, the company should be in a good place. And then you can also see the ROE, ROA, and net profit margin numbers. Both of these are higher than the two competitors that we looked at and industry average. So our company is doing very solid in these aspects for profitability.
So for our growth opportunity, we're actually looking at sort of global reopening with China and the rest of the world. As you can see, for 2020, China made up about 58% and the rest of the world at 42%. From the earnings call this year, we know that they are expecting China to grow a bit more and then plateau from there on out, which is why we're assuming that China will stay at about 60% and the rest of the world at 40%. And China was said to be the first to recover from the pandemic, which is why we saw such great success this year. However, they are planning to host the Olympics, so they are planning to cut back on domestic production. So just something to keep in mind. And then for the rest of the world, a big factor is the infrastructure bill that just went through, a multi-billion-dollar bill. We really hope to see that spark some success in the rest of the world. And then our growth is based off of tonnage, which is coming from GDP growth for China and rest of the world, and then also growing from commodity prices, which is based off that 5-year historical. So our tonnage growth for China starting at that 8% for 2021, and then tapering off there on out. And then the same for rest of world tonnage starting at that 6% and tapering after that. For iron, aluminum, and our other commodities, we're seeing more of a consistent growth at iron ore with 8%, aluminum with 5%, and other commodities at 5% as well. So our growth opportunities is mainly consist of iron ore, aluminum, and then our other commodities. So this is just for our baseline iron ore segment. So we started with rest of world tonnage and China's tonnage, which we saw was growing at those growth rates from before. And then the price of iron ore, we see that big spike in 2021, as we saw in that first graph, but it comes back down thereafter and growing at that consistent growth rate. Then we have revenues from China and rest of world to give us our total revenues for iron ore. And then we have our earnings, which is based off a 37% profit margin. And then our shares to give us total earnings per share for our iron ore segment. So then we see our total aluminum and other commodities there too. Calculated those the same with those growth rates. We see iron ore consistently making up a large percent of that. In 2022, we do see a decrease there. That's mainly just from that iron ore price coming down, but we expect to see growth from there on out.
So with RIO, being a mining company, we do see a little bit of risk with depleting resources, and therefore we decided to show this. They have many mine expansion projects currently in place to keep up with demand. For example, Pilbara is their iron ore section. They have 16 current mines in Pilbara, and they're adding on the Gudai-Dari mine. which will start producing 43 million tons of iron ore per year starting at full production in 2023. The Amrun mine is a bauxite mine for their aluminum. This is a part of the Waipa mines in Australia. This is expected to not only make up for the depleting resources in those mines, but also add an additional 10 million tons of bauxite per year. And the Oyu Tolgoi mine is a copper mine that is expected to reach full operation in 2030, making it the 4th largest copper mine in the world. And RIO has a 34% share of this mine. And with all this and other expansion projects, it is clear to see that they are not currently depleting in any resources. They're actually, they actually seem to be increasing production overall, and for that reason, we think that they will not have an issue keeping up with the increasing demand with markets reopening.
So in this table, we had 3 scenarios that we did our EPS projections based off of: baseline, optimistic, and pessimistic. So you can see here for 2021, our EPS decreases and then increases there on out. And then these growths right here are based on the year-by-year EPSs. So with 2021's, we calculated that based on 2020's EPS, which was 6.43, and then calculated those values in this table. And then in this table, these numbers mainly came from Rio Tinto's value line report, where we imputed these values into a spreadsheet, and it helped us come up with our target price, target return, PE, etc. And then figure 14, you can see that our 2022 EPS estimate, 6.15, and followed by the EPS estimate of for 2022, and then which would give us the 2022 price estimate. And then same thing for discount cash flow model based on our 3 scenarios: the FCFF value, FCFE value, to give us our average value of those. And then based on all of the numbers in the spreadsheet, gave us a target price for our 3 scenarios there. And then current price is 63.38. When it comes to also coming up with the target return, we also had a different dividend yields as well to come up with our returns. So for baseline, we had 7%, pessimistic at 5%, and optimistic at 10%, really because RIO has like a floating dividend. So we decided that this would be good in our analysis because the current dividend yield right now is 11.02 according to Yahoo Finance. So we decided to work with those to come up with our returns in respect to the target price.
So some of the risks involved with RIO, we have supply chain disruptions. We saw a lot of that during the pandemic. RIO does have some of their own railways and ports, so it kind of helps with these risks. And then community relations and environmental issues, as Callie talked about in our ESG slide. And then, of course, commodity price fluctuations. Because iron ore makes up such a large part of our total revenue, any fluctuation in that price can have an effect on RIO.
Next, I'll be talking about our portfolio fit and how RIO fits into the Spellman fund and the stocks that we currently have. Here you'll see a table with all the stocks that are currently in our fund and how they relate to RIO through their correlation coefficient. And as you can see, there's a range from 0.04 to 0.43. We rate this kind of favorable for RIO, seeing as it is a little bit lower. Obviously with EMR and Disney and such being so high, it does drive it up a little bit. However, with our optimal portfolio weight of 4.04, we actually decided to side a little bit more conservative, considering S&P 500 suggests a 2.27% portfolio weight for basic materials. And we are just starting out with it, so we decided to start a little bit more conservatively. And then, as you can see here, the average correlation for RIO with the rest of the fund is 0.239. This is below the fund's average correlation, which is 0.331. This would help to diversify the fund, seeing as we don't have any current basic materials, and it would help with having a cyclical stock as well. As you can see, it would reduce the risk in helping with it diversifying the fund. However, EMR, we are recommending a sell of 30 shares. This is because they do have the highest average correlation throughout the entire fund. They're also the highest correlation with just RIO. Therefore, we are recommending a 30 share sell. We have room to do this considering the optimal weight is below what we currently have in our stock or in our fund. For this reason, we are also recommending a sell of Apple. They are the most heavily weighted stock in our fund currently and overweighted by 8.58%. For this reason, we're recommending a sell of 80 shares, and it would also drive down the correlation for the entire fund, reducing risk a little bit as well. And with the combination of these two, selling it will provide roughly the same amount of cash that it would cost to buy 270 shares of RIO.
So just kind of to hit some of our main points again, RIO is leading the mining industry in iron ore and aluminum. We expect to see some great growth with China and the rest of the world reopening. They have a very strong balance sheet with low debt, and they have consistent dividends with the standard dividend and then extra on top of that depending on performance. And then they also provide a great diversification for the portfolio. With a target price of $87 and a target return of 44%, we are recommending a strong buy of 270 shares of RIO, with selling 30 shares of EMR, which is highly correlated, and selling 80 shares of Apple, which is very overweight. And for all these reasons, we think RIO would be a great addition to the fund.
Any questions?
I'm just gonna ask one.
Yeah, no, ask more. Go ahead.
It's a 7-part question. No, can you go back real quick to page 19, slide 19? This is just a style thing for me. I think of green as good, red as bad. When we talk about portfolio correlation, but I'm glad you picked EMR to sell. We had a group that chose one with a very high correlation to keep. So it's kind of an interesting comment. So, okay. Go to slide, don't go to this slide yet. I'm gonna ask a question first. If I've got 3 companies, one's growing at 5%, one's growing at 10%, one's growing at 15%, which one of those is gonna have the highest PE ratio, do you think? Which one are you willing to pay more per share for, per dollar of earnings for?
15%.
Okay, so go back to slide 17. If we're assuming different growth rates, why do we assume the same PE ratio?
Yeah, so we did look at changing the PE. We just decided to keep it constant for our assumptions. But yes, that is another thing that we can change if we were given more time and going further.
And it doesn't necessarily have to be scientific, but if I was looking at this and I said, all right, my base case is 4% growth, but my pessimistic is 2 and optimistic is 6, I would adjust the PE ratios accordingly. Maybe in that optimistic scenario, expect maybe a little bit of a multiple expansion, and in a slower growth scenario, a little bit of multiple. So just something to think about on that.
Thank you.
Better? Sure. Okay, one last. You brought it up right at the end. You commented on the dividend. Walk me through that, because we were sitting over here looking at the what I could only describe as the variability in the dividend. Part of it, I would imagine, is currency, but tell me about the last statement you made about regular dividend, performance dividend.
Yeah, so they have a dividend, they pay out dividends consistently. But like during the pandemic, they still continue to pay out their dividends, even when a lot of stocks decided not to. So they had that, but then they consistently pay out a normal dividend. But then if they are doing really well one year, they'll pay out an extra portion for that dividend.
Now I'm done for real estate.
So when you look at their dividends here on value line, they pay in June and September. Are one of those months the bonus, or do they just always pay within 4 months of each other for the two of them, then no dividend? You know what I'm saying?
Yeah, that, we did not necessarily look at in our research, but, that's also something that we could look into more.
I'm just thinking, you know, one of those columns might be their regular, you know, dividend, which has increased a great deal also. But the other column is increasing a great deal too, but I'm just wondering, what is the regular dividend? Do you know what the regular dividend is based off of right now?
I'm not for sure. I know when we were looking at the dividends, they kind of had it all together, so it was a bit hard to pick out which was actually the extra. I would have to look at that more.
What I saw is that there's a big difference every time they pay it. I mean, there's no consistency. It looks like, you know, it's $4.23, then $2.12, then $2.31, then $1.55, and then $4.02, and then $5.61. So
By consistent, I meant more so like
they pay it.
they always pay.
Yeah, they pay it.
Yeah.
Yeah. It looks like it's a variable dividend twice a year. And I think it's based off of cash flow during that probably previous 6 months.
Yeah, it's also a UK-based stock.
Yeah.
So you're also translating currency back to US dollars. So they're going to publish it in US dollars, and depending on what the exchange rate was at the time, you can see an actual increase in the dividend and a decrease in the US dollar, which makes it even harder to guess what you're going to get paid.
Do you go to the slide where you have the historical earnings per share and revenues? I can't remember which one.
Oh,
It was earlier in the presentation. No, I think it was the up a few, actually. Where you had the financial ratios. I think it was demonstrated there. Well, maybe forget the slide. I'll just ask the question, because you made the comment when whoever was presenting it, how it's a cyclical company, and so earnings seem to be sparse year in, year out. And then when you did your projections, you used like 2022 earnings per share. Did you, in your research, consider using like average earnings over the next few years to help counteract the fact that we're in this, you know, strong economic environment? So the earnings are going to be higher now, but they will likely fall off. At least historically, they've seen, you know, dips. So I'm just curious if you consider that, because you made the comment when you talked about historical, you recognize the variability of the earnings. Just when you're making projections, you use, you know, just the one number.
Yeah, somewhere in our calculations here, I looked at 2018 to 2020. I did not fully include 16 and 17 because they were negative. So I kind of wanted to get a good idea for those 2 years to go and calculate the EPS, which I believe went into PE. So yes, I did look at the historical EPS as well.
So when you made your projections, you got your target price, do you feel like that's just like this one year outlook? So I think when we're considering buys, we're looking out more than 1 year. Any thoughts into, is this a stock we should buy for maybe a short time period to take advantage of this cyclical boom and then consider selling, or do you feel like longevity, there's some value to it as well?
So, okay, so from the stock price, we know it's been at around 80 when we had that really high spike with the iron ore pricing. So we do believe that target price is a pretty good indicator of where it can get back to. We know that a lot of the stocks in the fund are growth stocks, and we know that this is not that, but we think it's a really great way to put some more funds into the total
I agree with that. I guess, do you feel like, going back to my question, do you feel like this is a shorter term buy or a longer term buy?
Probably shorter term, we would say either once it hits that target price or watching the commodity prices and GDP as well, since we've seen those kind of correlate with the stock price.
Okay, thank you.